All right, so this video I'm going to talk a little bit about phase one in the stock market cycle as part of the business cycle. And so to kind of review a little bit about what I'm referring to as phase one here. So if we go back to this, the phase one is going to be sort of that late contraction period as far as GDP is concerned. So if I'm looking kind of that late contraction period, that's going to be the phase one that we're looking at here. All right, so now let's kind of talk about this. So typically what's going on in phase one in that period there is that's generally going to be the bottom of the stock markets, but before the turn in the economy. So generally the stock market is going to turn before the turn in the economy. And the reason for that is that the stock market is based upon expectations. So when people start expecting things to improve, then the stock prices start to reflect that, even if things haven't actually improved yet. So from that perspective, generally, I would expect the stock market to kind of hit a bottom and kind of start going back up before the economy has necessarily fully gotten there. Now, there are certain companies that are going to tend to do a little bit better in this kind of phase. So financial companies would typically do well here. So whether it's banks, savings and loans, financial services, insurance companies, real estate investment trusts, brokerage firms, utilities, electric companies, water companies, gas companies, telephone. So if you're thinking, what's causing that? Well, the key or driver for this is basically the reduction in the interest rates. Okay. So if we kind of go back to what we had here, during this period here, normally the Federal Reserve is lowering those interest rates. So if they're lowering the interest rates, let's kind of think about what that does for these kinds of companies. Well, first off, what is that going to tend to do to the yield curve? Well, it's going to make the yield curve very normal. So those short-term rates are going to go down. It's going to be a very steeply sloped yield curve with the short-term rates very low, longer-term rates are higher. And so as a result, for banks, typically they have loan portfolios of loans that are longer in term, but they are paying depositors those shorter term rates. So as the shorter term rates come down, basically there's a bigger spread between the long-term interest that they are charging on loans that they've made and the short-term interest that they're paying to the depositors. And that spread's getting bigger as the short-term rates get lower, hence why banks, savings and loans, things like that, and a lot of these financial companies tend to start doing a little bit better. Also, basically, you start getting a little bit more market activity, so that brokerage firms start looking a little bit better, things like that. But let's kind of talk about the utilities here. So the utilities tend to be characterized by relatively stable and consistent cash flows. So if you think like electric companies, in the United States at least, they're heavily regulated in the sense that they can't just expand wherever they want and plug power poles wherever. Basically, they're heavily regulated in terms of geography and things of that nature, and their profits are regulated and so forth. But their earnings and cash flows tend to be somewhat more stable, and because they're somewhat more stable and somewhat more predictable, they kind of start looking a little bit more bond-like in some respects. They're not the same thing as bonds, but they start having some characteristics of cash flows that I would argue is a little bit more bond-like. And to the extent that that's the case, when those interest rates start going down, then for a relatively stable set of cash flows, the present values start to go up. And so basically, utilities start looking better due to that. So the valuations start to look better because of that situation. So basically, that's kind of driven by those interest rates as well. So if you're thinking, what are the overall economic conditions at this point? Well, the overall economic conditions at this point, pretty much down here, the economy is still shrinking, right? So the economy is still shrinking. Bond market peaked somewhere, or sorry, hit a trough somewhere back here. So the bond market's improving. Stock market is going to hit a bottom somewhere, maybe kind of in this late phase one, early, before phase two, somewhere in there. Stock market's basically kind of hitting that bottom, right? So bottom of the stock market's happening somewhere in this general vicinity here. Unemployment is still lousy, right? Economy still shrinking and not growing. Interest rates are low because the Federal Reserve has lowered them. Inflation is also low because the economy has been pretty lousy. So typically inflation's low, interest rates are low because the Federal Reserve is chasing that. Unemployment is still high because we're in a recession. Stock market's hitting a bottom somewhere in here. Bonds pretty much already turned for the most part. And that's the basic idea of kind of the environment that you're looking at in this context. And so that's ultimately going to kind of create the context for the company. So if you have companies that they typically do well in that kind of situation where, the lower interest rates, things like that. That's typically when they're going to tend to thrive, or at least start thriving a little bit more. Okay. All right. Hopefully this little discussion of phase one has been helpful. Thank you so much for watching, and have a great day.